everybody goes, so not really very much going on, but there's tons going on at the moment. We've got the progress of the Finance Bill 1920. Haven't quite worked out how that works while Parliament's not sitting, because of course it should be working its way through. But an awful lot of the changes that relate to that are to do with the big corporates. So I've not really touched on that today, because I didn't think for a lot of you, you would be hugely interested in that. So what I've chosen to do, that's the legal stuff, we need that. What I've chosen to look at is pensions. Now, there haven't been a lot of big changes on pensions this year, but it is a big topic area, and quite often people ask you, what's this fuss about the doctors and why are they retiring and stuff? So it's quite interesting to look at the pensions. And last year I had a client who had been advised by his financial services chappie to top up his pension fund, but what he hadn't realised is he didn't have a £40,000 allowance anymore because his income was too high. So I'm going to touch on that to start off with. There are some big changes coming up on residential property and capital gains tax. They are actually current legislation coming through effective from April next year, but they're very big and important. But it serves quite a useful way of revising what happens at the moment with residential property, because again, I was at one of the big investment houses in Liverpool was doing an event probably 2 years ago now, and one of the people there stood up and said, well, of course, the best thing you can do is to buy a house and you move in while you do it up, and then you sell it and you make a profit. But of course, you don't pay tax on it because it's your main residence, and you buy another one and you do it again. And I had to take him to one side and say, excuse me, that doesn't quite work like that, and you're giving them duff advice. The other big thing at the moment in practice, of course, is employment status. And there is a huge amount going on there with a view to bringing in these new rules next April. Excuse me. So we're going to have a look at that. And then we've also got some new capital allowances knocking around. We've got a structures and buildings allowance came in last October. So we're going to have a look at that. And that's the programme for this morning as we go through. So let's talk about pensions. And I'm talking primarily money purchase. I'm not going to go into the defined benefit and the increasing it and the multiplying it by 16 and all that. I want to look at the money purchase because that's where most people are these days with their pensions. And we have an annual allowance of £40,000, which if you don't use effectively can go forward for 3 years. But again, classic mistake, actually the same people, same financial services business. If you've not made a pension contribution before, you can put in £160,000. No, you can't. If you haven't got a pension, you haven't got any unused relief. So you have to have had a pension in the earlier years, but maybe you are a sole trader, so your profits are fluctuating, you're in the early years of your business, and you can't afford to put a lot in, but you have put something in, and the pension is up and running, or the scheme is up and running. It's just that you haven't put the full 40,000 in. Now, if you put in more than £40,000 or whatever your limit is for the current year, the excess is taxed on you and it's treated as the top slice of your income. So if you're looking at somebody who can afford to put £40,000 into their pension, the chances are you're looking at somebody paying tax at 45%. And what you will get quite often, particularly with the owner-managed business, is where you have the company putting in the pension contributions and they've got some spare funds this year because they've done something or other, and they don't realise the implications that if they put in more than this amount, then it's the individual who then ends up picking up the income tax charge. Sometimes there's a discussion about, well, if I put a lot in through the company, am I going to get the corporation tax deduction for it? And the answer should be yes. So the revenue used to argue that if you're only taking a salary, I mean, it's not unusual, is it, for them to take a salary of about £8,500, which is around the NIC threshold, and then everything else comes out by way of dividend, which of course is not pensionable income. And the revenue started to challenge these large contributions, but they were knocked back. Dawn Primarola, at the time involved in tax, said, no, if it's your business, it's up to you how you take the money out. So if you choose to take a low salary and then a mix of pension and dividends, that is totally up to you. But when you're looking, for example, at the wife, the spouse or your civil partner, I have to be very politically correct in these days, don't I? If you are looking at your spouse or civil partner, if you're paying them a salary through the business and they are not a major shareholder, you do have to be quite careful about putting too much through. Otherwise, the revenue might disallow the CT deduction. Because if you were paying an employee who wasn't your spouse 10 grand, you wouldn't put 40,000 into a pension for them. And that's the way that they sort of look at it. It's the same with the kids. You know, if you employ your child, you can't put in more than you would put in if it wasn't your child that you were actually paying. So you don't get the CT deduction in that situation. Now, if you are looking at accessing your fund, so you go in and you take one of the access amounts from the fund, what will happen is you are allowed to take out 25% tax-free, up to the lifetime allowance. Anything over that, the tax rates then go up depending on what you're going to do with the excess. But if you do take any amount over that 25%, your limit drops from 40,000 to 4. And what they're looking at there is they don't want people who are taking money out of the pension fund, recycling it back in. Because, I mean, you can access your fund at 55. So an awful lot of people work well past 55, particularly with the state pension age, nearly at 67 for most people now. And so they take money out and they think, oh, I don't really need the money, I'll take it out, but I'll put it back in to ramp up the tax relief. And so if you do take out your 25% or less, that's absolutely fine, no problem. But if you take out more than 25%, it reduces your allowance right down to 4. It's not a tapered reduction, it's just it comes to 4. The tapered reduction applies to the high earners. And if you've got a, oh, sorry, I'm pressing the wrong button. If you've got a high earner, what you've got to look at is what they refer to as their threshold income and what is their adjusted income. Now, your threshold income is basically your taxable income. You're not going to have much of a personal allowance in there if your income's over 110, probably. It will depend on the numbers. But you are allowed to deduct your pension contributions that you make. Okay, so under the old system, I don't think anybody's old enough in here to remember it, you used to get a deduction in your above the line comp for pension contributions, and so a lot of these limits are based on the assumption that although we don't do it that way anymore, we can still work out our tax relief accordingly. Now, in a lot of cases, the employee won't be making any contributions, the employer will be making all of them, so it's possibly just their taxable income. The adjusted income is then £150,000, and that is your taxable income plus the money that the employer puts into your pension scheme. So if you've got an income of, you know, £130,000 and the employer's putting in 15 or 20,000, that can have quite a big impact on this restriction. And if you've done a salary sacrifice, instead of having salary you take pension, you have to actually add in the salary that you've sacrificed for the pension that you are getting. So they think of all of these things when they're trying to work out the limit. So take your taxable income, knock off your contributions, and if it's a money purchase scheme, you'll need to gross them up. So if I put 8 in, that's a 10,000 deduction. And then it's your taxable income plus the employer's contributions to get to your adjusted income. And once you go over the threshold, you lose £1 for every 2 that you are over the limit. But it can't go down below £10,000. So, I'm sorry, this is not my clicker. My clicker works the other way, so I'll need to keep my finger on there. So if we have a chap there who seems to have a bit of a peculiar tax year there, I'm sorry, it says 197, it should obviously say 19. He pays £8,000 into his pension, his company pays in £15,000, and he's got £140,000 worth of taxable income. So there's no personal allowance, because of course he's well over the threshold whereby he's going to lose his personal allowance. So what you do is you say, well, okay, I need to work out these two figures. The first one is my threshold income, which is his taxable minus his pension contributions. Now, if that is not over 110, then you stop. You don't need to do the second test because you've got to meet both criteria. And I am meaning to go backwards this time. There are 2 criteria and you've got to meet both of them. Your threshold income's got to be over 110 and your adjusted income has got to be over 150. So if your threshold income isn't over 110, well, then you stop. Well, his is. So we move on to the second test, which is taxable income plus the employer's contributions, which makes it 155. So he's 5,000 over the £150,000 limit. So he will lose 2,500 out of his annual allowance for that year. And if we don't use it all and we're carrying it forward, the amount that's carried forward is based on that 37,500. So this is where you've got to be quite careful, because of course when you're doing this sort of thing, the sort of pension review takes place before the end of the tax year, because they're saying, well, you've got to get your contributions in before the 5th of April. And sometimes you don't have the full picture of what your income is going to be until you go post-year end. But where you have got the high earners, they have got to be very, very careful, because as soon as they put in more than that 37,500, they're going to be looking at paying tax at 40 and 45% on the excess over their threshold. Now, the other thing that has changed with pensions over the last couple of years is the options for what you can do with your pension fund. Now, again, please, this is money purchase. It is not defined benefit. Defined benefit is totally different. So money purchase, you can take out some money and then you can buy yourself an annuity. Very rarely these days is that an efficient option, because the annuity rates are so low. If you look back to when my father died, the annuity rates were about 6 times higher than they are now. My mother's got a fantastic pension based on the annuity rates when my father set up his pension such a long time ago. But now they're rubbish. The only time it might be worth looking at that is if the individual is in ill health, because then you can quite often get an enhanced annuity rate, because they're banking on you, pegging it in a lot shorter time than the rest of us will hopefully be here for. You could actually take the whole amount in cash if you wanted to. 25% up to the lifetime allowance is tax-free. The excess is then treated as taxable income, and that would give you quite a big tax charge unless the fund itself is quite small. You've got flexi access drawdown, where again you can take up to 25% of your up to lifetime allowance tax-free, and then the rest of it you can use to produce an income stream. So basically it's a bit like an annuity. Or the one that a lot of people are using at the moment is you take just bits as you want. Give me £20,000, I want £30,000. 25% of that is tax-free, and the rest of it is then taxed as income. And the government are very, very worried, because of course this flexibility in the pensions has meant that a huge amount of people are drawing down money out of their pension scheme, forgetting, of course, yes, it's quite nice to not have your child come out of university with debt because you've paid for it, or you've given them money to get onto the housing ladder or whatever. But people are living longer these days, and the cost of living is going up. And they're very worried that a lot of people are taking money out of the fund and are not thinking about how much they're going to need for the remainder of their life. The problem with that is you don't know how long you're going to be here, do you? And you don't know how much you're going to spend. And my view on that is, well, by the time you run out of money, you're probably going to be gaga anyway, so you won't know. So let's take the money out and enjoy it. But the other thing, which is a huge change, is prior to the change that we've got here, which is a couple of years ago, if you died and you hadn't accessed all of your pension funds, so you've been taking chunks out, but you hadn't actually accessed all of it, what was left went into your estate for inheritance tax, and so you'd lose 40% on it. But now what you can do is you can actually nominate beneficiaries for your unaccessed funds. Now the key to this, and I say this, I do a lot of practice stuff, and the number of times I'll say to people, have you actually filled out the nomination forms? Because if you don't fill out the nomination forms, it doesn't work. If you go onto the website of your pension provider, you can just download them and you send them in, but you have got to nominate who you want to inherit. And unfortunately, a couple of years ago, my sister was very poorly and subsequently died as she was expected to. And when we went down, she wanted to talk about this, that and the other. And she hadn't nominated her pension fund. And she had quite a substantial one because she'd worked for a long time. And she herself didn't have any kids. So she didn't spend as much money as the rest of us. And we got the forms sorted and signed. And it saved us at the end of the day about £180,000 in inheritance tax. Because if she hadn't hadn't signed those forms, her fund would have gone into her estate. So it's really important that you get this nomination right. So for the younger ones in the audience, this is a conversation you need to have with your parents over Sunday lunch. Have you got a pension fund? Is there any money in it? And make sure you fill out these forms. Now, when you have then got this nomination on, Bob and I have nominated our pensions to the 2 kids equally. So what happens when we die is if the fund hasn't been accessed, if I am under 75 at the point of death, then they can have exactly the same choices as I've got before I die, which is an income stream, or I can take chunks out, and anything that they take out is totally tax-free. Yeah? And that is the stunning aspect of the changes that they made. So if I died now, I am under 75, you might not believe it, but I am under 75, the kids will be able to take my pension pot totally without any taxes at all. If I'm 75 or over, they're allowed to take out funds, but once they take out funds, they will pay income tax on it. But it does mean that they can leave it in the fund until they come to retirement age. It's a good start to their pension fund, or alternatively, they could take bits out of it. You know, I could take £10,000 this year to go through university. I could take £20,000 next year to pay a deposit on a new house. So it really is quite a stunning pension plan now as a whole investment strategy. Because if you think about it, you put the money in, you get tax relief when it goes in, either because I'm putting it in personally or because my employer is getting a deduction for it, and in a lot of cases I am the employer. It sits in a tax-free environment. I can access it when I am 55, and you've got to say, well, surely that's got to change. If state pension's coming in at 67, how can it be right you can take your personal pension at 55? And then if you nominate it on, what you haven't taken can move on to these beneficiaries. So you've got this totally tax-free environment where you get the relief when you go in. No, absolutely anybody you like. Doesn't have to be a direct relative if that's what you're asking. So, excuse me, my sister, when she died, because she didn't have any children and her husband had already died, she nominated her nephews and nieces. But it could just be a friend down the road. It could be literally anybody.
Does it have to be a person? Can it be
a charity, for example? Yes, I think it can. But for most people, it's going to be the person that they're interested in, isn't it? And so you sort of contrast it to ISAs, don't you? You can put money into an ISA, sits in a tax-free environment, and then when you take it out, it's not taxable. But the ISAs do go into your estate at death, so potentially you could lose 40% on them. If you leave them from husband to wife, for example, there's no tax at that point because it's into spouse. But when the second spouse dies, then there would be some inheritance tax there. The only advantage of the ISA, of course, is that you can take the money out at any time. With the pension fund, unless you want to pay a huge amount of tax, then you can't take it out until you're 55. And it's the big scam at the moment, isn't it? I was sat in our Birmingham office the other day, and the lady I didn't know her terribly well, was sitting just along from me. She took a phone call and she started talking about her pensions. And when she put her phone down, I said, "Was that a cold call on pensions?" She said, "Yes. He says I can access some of my funds and they'll sort it out for me." She's well under 55, so it'll be an unauthorised charge, and then these people take 15 or 20% as a fee, so you don't actually end up with an awful lot. So pensions is the big one at the moment, which is one of the ones that the scammers are after, so you do have to be careful. But it's a very interesting investment, and of course for the high earners, they've got to be careful because of that restriction on the £40,000. They can only get in potentially £10,000 a year. Okay, let's talk about residential property. This is property deemed it's a dwelling house, it's a whatever it is, it's a residential property, and we have these exemptions which are available if it is your main residence. Now you might call it principal residence, you might call it only a main residence, the terminology is interchangeable. And what happens is when you come to sell it, The last 18 months are currently exempt. And what that does, it allows you to, we're selling our property, but we haven't got it sold yet, but we've bought our new one because I've got to move. So I've bought my new one. That becomes my principal residence, and you can't have two at the same time. So the old one becomes chargeable. Now, originally, some of you will remember, we used to get the last 3 years exempt. Then they cut it down to 18 months, unless you are ill or in care or something like that. They've kept the 36 months for that. But what's going to happen from April 20 is they're going to cut that down to 9 months, because the revenue say that they think 9 months is enough. And when you look at it statistically, the vast majority of people in this situation will sell within 9 months. But unlike the old rules, there's no provision for the revenue to give you a bit of an extension if there are extenuating circumstances. So it's going to be 9 months from next April. Rent-a-room relief, they're also after, because people have been claiming rent-a-room relief when it wasn't really the intention of the legislation. When my granny was alive, she used to rent out rooms in her house to students in the local college. And it was great because it meant there was somebody in the house, because she was going a bit gaga, but there was somebody in the house and she got a little bit of income, and of course she shouldn't have to pay income tax on that really. So they introduced rent-a-room relief, which was £4,250. I think it's now £7,500. But what's been happening is people are claiming rent-a-room relief in a situation where it wasn't intended. So I am in the situation where I've got a house in Liverpool, and say the Golf Open is on in Hoylake. So I rent my house out for a couple of weeks and I go off to the Maldives, and then I come back, I've got rent for 2 weeks, and I say, I'm not paying tax on that, it's less than £7,500. And that's what people have been able to do. And that is not what it is intended for. So now, from April next year, you'll be able to have rent-a-room relief only if you have shared occupation with the owner and the tenant. It doesn't have to be 365 days, but you've got to have them living together effectively, unless the owner's off on holiday for a couple of weeks, or it's summer holiday time for the students, or whatever it is. But there's got to be shared occupation now, otherwise the relief will not be available. And they have done the same for the letting exemption. Now, the letting exemption is an exemption that was given really from a capital gains tax perspective. It's the same as the rent-a-room relief. When you sell your house and you're trying to claim that it's exempt, if you've been letting it out, then it's not wholly your principal residence, and therefore a proportion of the gain should become chargeable. But then again, we say the first £40,000 isn't charged. There is this letting exemption which allows you to take out £40,000 worth of gain. I'll show you some numbers in a second. And what they're saying now there also is you can't have that £40,000 from next April unless you have got shared occupation of the property. Now, when you are looking at property, just to do a recap of this, if any of you haven't seen this for a while, if I have got a house, I cannot live in it 365 days for the number of years that I actually live in. So the odd holiday is ignored anyway. But say I got sent abroad to work. So they send me to Hong Kong and I work there for 5 years and then I come back. Now, technically, I am not living in the property, therefore it shouldn't be exempt, but it is allowed to be exempt because I am employed elsewhere overseas. But you have to live in it at some time before and at some time after. It doesn't have to be immediately before. So I could be living in the house and then renting somewhere else for a while and then going abroad and then coming back. So it doesn't have to be right before and after, just has to be at some time before and after. The same if I'm sent somewhere else, they say, okay, I want you to go and work in Glasgow office for a couple of years. I keep my house on. I don't want to drop off the housing ladder. I keep my house on. And again, as long as I'm not there for more than 4 years, as long as I've occupied at some time before and after, that period is ignored. And even if I am renting it out, it is still exempt. The exemption sort of overrules the letting. That's the key thing to this. Okay, and then we've got 3 years for any reason. So I decide to, travel the world and find myself for a couple of years. So I'm not employed anywhere, but you are allowed 3 years. And again, you must have occupied it at some time before and after. Now, the practicalities of that is with the 1 and 2, You have to have lived in it at some time before, but if your employer prevents you from reoccupying it for a substantial period of time, you can still have the exemption. So if I come back from Hong Kong and I can't go to Liverpool, which is where my house is, because they send me straight to Glasgow, I would still be able to claim the exemption. Okay? So really, it's only for the 3 years for any reason that we need actual occupation both before and after. For the other two, if you choose not to come back, yes, you're not going to get the exemption. But if you can't come back because of your employment, then that's fine. And if you're looking at somebody who's self-employed, they get 4 years working elsewhere, anywhere, and then 3 years for any reason. They don't get the unlimited absence overseas that an employee gets, because an employee has less control over where they go for their employment. Now, if I let it, as I say, during the absence, but the absence is deemed to be occupation, the letting is irrelevant. But if I then let it in a period which isn't deemed occupation, because maybe I've got a house somewhere else, that's when the £40,000 comes in, because I'm going to let it out. And that rental income will then qualify me for the £40,000 exemption, but it won't from the 6th of April 2020. So if we take the deduction, the way the deduction works, you're allowed to deduct the lower of the gain that I've made on the property, the gain which is exempt on the property, and the £40,000. So if we look at old Boris here, it's got to be Boris at the moment, hasn't it? Buys a house, he owns it for 26 years, and he sells it and makes a gain of £240,000. Now, he lived in the house for 7 years. Then he went to work overseas, but he did come back and live in the property afterwards. It doesn't have to be immediately after, but he did come back and live in it afterwards. So that period of overseas, although he's renting the house out and he's not living in it himself, is exempt. It's one of the periods of deemed occupation, so it is exempt. He's then living in it again for another 6 years, and then he moves out and he buys another house, but he decides to keep renting the one that he's moved out of. This is what my son's hoping to do. He's just bought his first house. He's hoping that in a year or two, he'll be able to buy another one and then leave the first one as a rental property. So he's moved out, he's got a new PPR, so this one cannot be PPR. We can't claim 3 years for any reason for that period at the end, because he hasn't lived in it after the period. He's moved out and now he's renting it. So he's allowed to claim the last 18 months because it has been his principal residence at some time during that 26 years. And that means the 6.5 years left where he's renting the property and he's not living in it. So you take out the period that he is exempted. That's the period where he's living in it, where he's deemed to live in it, leaving the gain for the rest of it. And then because he's been letting it, you're allowed to take out the lower of those three things. The exempt gain, which is the 180, the the let element gain, which is the 60, or £40,000. It's the lower of those three, so we end up with a gain of 20. Now, if you sell your property on the 5th of April 2020, and you've got that pattern, that's your gain. If you sell it on the 6th of April 2020, all bets are off. You only get the last 9 months as deemed occupation. There's no transitional period at all. You only get the last 9 months. So you've now got 7.25 years where you've been letting it and it's not covered by one of the exemptions. And when you come to work out your gain, you cannot deduct the letting relief, because you've had no shared occupation with the person who's been paying you the rent. You've gone away, you've let the house out while you're away. And so that ability to claim the £40,000 disappears. So the two changes mirror. If you've got if I use the term very loosely, a lodger, you can have rent a room relief for income tax and the letting exemption for capital gains tax. If you are not living in the property while the letting has happened, you can't have rent a room relief and you don't get the letting exemption. And if you see there, that's quite a big change in your tax bill. Assuming it's a 28% taxpayer, and I've ignored the annual exemption, you're looking at an extra 13 grand of tax in that situation. So you're losing 9 months of the exemption, it's going from 18 to 9, and you're losing the £40,000 deduction. A couple of other changes that they've made. The first one is not huge, I don't think, in the context of what you're doing. This is where I move into my husband's house, and he's been living in it for a while, and it becomes my main residence as well as his main residence. Previously, what would happen is when we sell later on, they would only consider what had happened on my half of the property from the date that I move in. Now what will happen is you will pick up the history of the person that you've moved in with. So if Bob hadn't used it all the time before I moved in, that will be reflected in my calculation. And actually that makes life easier because it means we're both going to have the same pattern of ownership and non-ownership because I'll inherit what he had. The second one is much more important, and they are going to change the due date of payment for capital gains tax on residential property. Now this is going to be total mayhem because your disposal date for capital gains tax is the date of the contract. And of course, for those of you that have bought property, you know that there can be quite a considerable amount of time between the date of the contract and the actual exchange and movement of money, etc., etc., etc. Now, the only way you can get around that is if your contract is conditional, and then it's only once the condition is satisfied that the contract is deemed to then go through for capital gains tax purposes. So you've got to think quite carefully about this, and this will be something solicitors miss. You need to build a condition in, otherwise you could potentially end up with a due date of corporation tax, which is before you've actually got the money, because of the way the pattern works with the actual ownership and the sale, etc., etc. And then what you do is you work out the theoretical capital gains tax. So you'll work out your gain, you'll take off the annual exemption, because when you do your calculations as a whole, you always put the annual exemption against residential property if you've got a gain there, because you pay tax on that at 18 and 28. But for everything else, it's 10 and 20. So because you can choose, you always put your annual exemption against your residential property gains. And then you work out how much tax you're going to pay, 18, 28, depending on how big the gain is. And then when we get to the end of the year, you work out your capital gains tax in total, and then you credit off what you've paid. And it can be set off against income tax as well as capital gains tax. So that can work quite well when you come to have a look at these. Now, if you have more than one disposal, the second disposal is done on a cumulative basis. And you have to do that because we need to know where we're going to hit in the income tax bands to work out whether they're going to be paying at 18 or 28. If you make a loss on the second one, you cannot go back and ask for a repayment on the first one. You have to wait until we get to the end of the year, and then you calculate the gains with the losses within the self-assessment. If you've made one disposal and made a loss, and then you make a second disposal at a gain, then yes, you can take the loss off against the gain in that situation because you've already realised it. But if you've got two disposals of residential property, it's only the residential property losses that can be used in this way. The others you've just got to wait until we get to the end of the year. So that's quite a big change, and as I say, an awful lot of people will miss that, but it also ties into an extent to the change on the payment dates for stamp duty land tax, so it's really quite important that you look at that. Now, the other thing which has been causing a problem is this reduction of the interest relief. This is one of George Osborne's little gems. They were very concerned because, of course, a lot of people were buying properties to do buy-to-let, taking money out of their pension fund because they can, doing buy-to-let properties, and basically it was taking away the first-time buyers' properties in a lot of cases. And the market therefore became more difficult and the prices started to go up. So what they wanted to do was to try and get less people buying into this buy-to-let to release more property into the first-time buyers' market. It has worked to an extent, but I don't think it's worked quite as well as they thought it would. So what they've done is they've changed the amount of the interest relief that you can take above the line. Before 1718, when the rules were as they were, if I paid £10,000 worth of interest in the year, I could just deduct that off my rent as an expense, and then I paid income tax on what is left. What they've now done is they've said, no, you can have 20% relief on your interest. So basically, you don't put it into your rental income computation, you work out your tax, and then you say 10,000 at 20% is 2,000, and you knock that off your tax bill. Your tax bill's not big enough, tough, basically. But that is effectively what they've done. And they've phased it in, you can see, over a couple of years. And we're in the 50% above the line, 50% below the line if you're looking at settling last year's, and then it's 25 above and 75 if you're looking at this year's. So basically you are in the situation where you won't get the full tax relief on your interest. And quite a few people have said, okay, I'm not going to make enough money now, therefore I need to put the rent up. So it's been counterproductive in a way, because a lot of these houses, the rent has just gone up. And of course, because there's now a cap on rent that can be paid through the sort of the state system for people who can't afford to pay them rent themselves, it has caused more problems in that sort of area. But some people have said, no, they're going to sell. Some people have actually said they're going to put it into a company. But what they haven't thought about there is that their relief on their interest will then only be 19% this year and 17% next year, because that's the corporation tax rate. But there are different reasons for putting your property into a company, and I'm not going to go into that today because that's probably another couple of hours on top of what we're doing already. So what is going to happen is when you look at this, and this is where people look at you when you do this and you go, oh, I didn't realise that. The amount that you're allowed to deduct at 20% is the interest that is below the line, or your property income for the year, or the adjusted net income of the individual. And if you don't get full relief in the current year, the difference is carried forward. What people just assume is that if they've got interest of £2,000 below the line, 20% is 400, that's what they're going to be able to deduct. And that is not the case. I've got two examples here. This one is a slightly older one. As you can see, Teresa is still knocking around here. She's got quite a reasonable portfolio of property here. She's got rental income less expenses of 10, and she's paying interest of 3. Now, for this year, which is 17-18, she's allowed to take 75% of the interest as a deduction above the line. So that's the 2,250. The other 750 she takes below the line at 20%, and everybody just says, okay, 750 at 20% is whatever it is, and we will deduct that. And in this situation, that actually is the right answer, because you work out the tax on her income, and then your reduction is the bit that goes below the line, so that's 25% this year. Your rental profit, taking you back, is the no, I'm going forwards now. The rental income is 7,750, so that's one threshold, and then the other one is your taxable income, which is 41,250. So yes, 750 is the lower of the three, so you get your deduction of £150. But if we take Philip, Philip is also renting out, and he normally does okay, but this year there are some substantial repair costs going through, so his income has come down quite low. So when you look at it, his rent minus expenses is quite low. So he's only got a rental profit of £100. Now, when we come to have a look at the bit of the interest he hasn't deducted, most people are going to say, well, okay, there's £900 there, therefore I'm going to get a deduction of 180, but you're not. Because when you come to have a look at your calculations, the amount you can take the 20% on is the lowest of the £900, or your rental profit, which is 100, or 12,600, which is your taxable income. So actually it's £100. So he will only be able to take a deduction of £20 this year. The difference between what he's got, the 900, and the amount he's taken relief on is carried forward and added to next year's. So a lot of people will come unstuck there if they're in the situation where they have got quite a low rental profit for the year. It's not automatic that you can deduct 20% of the below the line figure. You have to do this 3 alternative calculation to decide how much can be deducted. Now, the other thing about this is, of course, by reducing the amount we can deduct from the rental, it is increasing our taxable profit. And what happens, therefore, is people's income is going up. People's taxable income. Let me just take you back again to Teresa. If we'd been able to put the full £3,000 through there, her rental income would have been £7,000, so her taxable income would have been £40,500, not £41,250. And each year that's going to go up as the movement above the line to below the line progresses. Now, your taxable income actually governs a lot of things, like the high income child benefit charge. And there has been quite a lot of publicity recently about people who've come into this where they weren't before and they haven't realised. Therefore, they haven't done the returns, properly, etc., etc. And there's some discussion about whether the revenue should be charging penalties. But they have had quite a big publicity campaign going on this one. But as your rental income effectively goes up, because you're no longer deducting the interest, you're more likely to get hit by this charge. Childcare vouchers, if your income goes over a certain threshold, depending on whether your basic rate, higher rate or additional rate, the amount of vouchers that you can have comes down. And so that might be impacted as your taxable income goes up. I mean, that's a bit of a short-term thing because quite a lot of people are moving across to the tax-free childcare account. But again, the amount that you can have there, you cannot have one if your income is over £100,000. So if you were tottering on the threshold and now you've got this interest effective disallowance and you go over, you can't have the account. Personal allowances we know go down if your income goes over 100,000. Your pension allowance can go down if your income goes over the threshold and the annual amount. So there's lots of things which are impacted by this change, not just the actual amount of tax that you pay on your rental income. So it can be quite expensive just to tip yourself over the limit, but there isn't an awful lot you can do about it. Yeah.
None of that is different from people's income going up for any other reason.
Yeah.
There's nothing special about it.
No, it's exactly the same principle.
You just got to be conscious of
yeah.
the order in which you do these calculations.
Yeah.
This kind of stuff.
Yeah.
You won't know your income on your rental property until you do the calculation year end.
Yeah. And part of the problem is, you see, in the first year that people do a lot of these calculations, they don't lose anything. So they don't really think about the impact next year of the income going up because they've now got a different amount of interest coming in. Basically, anybody who is on the cusp of any of these has to look every year. You see, an awful lot of these people are employees. Okay, and they've got the rental income and they quite happily put that into their return, but they don't sort of put two and two together because they don't know that they have to. That's the issue with a lot of these. It's only when the revenue come back and say, oi, because the revenue have wiped out a lot of penalties for high income child benefit charge from 15-16 and 16-17 because there hadn't been enough publicity about the impact of the charge. And that's the effect here. It's people who are maybe salaried and have a bit of rental income and understand how to work out the profit on the property, so they don't use an advisor. They don't see the implication of what's happening. Yes, David?
Well, their economic position is exactly the same, isn't it? Nothing's changed for them. It's just the rules that they've got to follow. For the individuals, there's not. If my profits were going up and I was self-employed, I ought to recognise that I'm now in a different position.
Well, you're in a different position net-wise, aren't you? Because you're paying more tax.
Yeah, as far as the individual's concerned, they don't feel that they're any better off because their income and outgoings are exactly the same.
Yes. Yeah.
It's the system's changed without them necessarily noticing.
Yeah, if you look at the effective rate on the deduction of the interest, depending on how it falls, it can actually end up over 100% if your numbers fall out in a particular way. So you can actually end up, because of the way the restriction works, paying more than 100% on your rental income, which is not good, because what they recognise is I've got this rent, I've got these expenses, and I've got that interest, therefore my profit is. And they don't sort of tie the two together from a tax perspective because they don't get the interest deduction from a tax perspective that they get in their accounts. So if you look at their accounting profit and work out the amount of tax they pay on their accounting profit, it's exponentially higher than it was when you got full relief for the interest. That's the problem. But they don't realise, they don't see it. The better landlords do because they're a bit more on top of things, but at the end of the day, most of them don't.
Do the online calculators have anything of this?
Do what?
Not advised. The online calculators for
Oh, no.
so none of this is...
Don't be silly.
No, I'm not surprised.
No, as far as I'm aware, the online calculators all work correctly for these calculations. That's what I would say. They don't always work properly. They don't work properly for top slicing relief on single premium life insurance bonds, but they do work correctly for this. But it's whether people realise they've got an issue and then suddenly they've got this bigger tax bill than they're expecting and they haven't got the money to pay it. That's where, and then they sort of start thinking, well, hang on, if I'm paying this much tax now, is it actually economic for me to retain the property? I mean, we had a couple of properties and we got rid of them because basically they were a pain in the neck to deal with, and the tax changes meant they were becoming less efficient to have. They were still okay, we were still making a profit on them, but it wasn't as good a profit compared with the hassle that you have of actually looking after rental properties and tenants who ring you up in the middle of the night because the boiler's broken and stuff like that, you know. So, yes. Okay, entrepreneurs relief is a big one that we need to look at in practice, because entrepreneurs relief reduces your capital gains tax rate on the disposal to 10%. It's got to be shares in a qualifying company or a sole trader partnership interest. If it's a company, you've got to own 5% of the shares, you've got to be a director or officer of the company, and it's got to be a trading company. Okay? Now, the first thing they've done with Entrepreneurs Relief generally is they have increased the ownership period to 2 years. So now, if you're in the situation where you are selling a property, it's 2 years rather than 12 months. The Revenue said that is more reasonable, 2 years, because it's meant to encourage businesses, and 12 months is quite a short period of time. So they've extended it to 2 years, and they're saying not very many people will lose out as a result of that. Where people used to lose out is if you were a sole trader partnership and you decided to incorporate and become a company. If, say, one of the new shareholders decided then that they were going to retire, there was a problem if they hadn't owned their shares for what was then 12 months, which of course is now going to be a bigger problem if it's 24 months, and it might delay the incorporation because the senior partner says, I'm not going to incorporate now because I want to retire in 6 months' time. And what they've done is they've changed the rules now. Previously, you couldn't aggregate the ownership of the unincorporated business with that of your shares in the company, but now you can. So if I've been a sole trader for 10 years and we turn our partnership in, if I've been a partner in a partnership for 10 years, turn it into a company, and then 9 months later I decide I want to retire and sell out, that's fine. I will now get my entrepreneur's relief. And it was always unfair that you didn't. You know, if the unincorporated business qualified, why shouldn't your shares in the company, which is running effectively the same thing? Now, the other thing that they've done, and this is a little bit of anti-avoidance here, is they've changed the ownership to 5% of the voting rights, which is what the old ownership was. But now you also need 5% of the dividends and 5% of the assets on a winding up. And because people were playing around with different types of share capital to sort of fudge getting entrepreneurs relief when they didn't really have that big an interest in the capital. So what we're looking at here is a situation where you now have to have 5% of shares. Have 3 rights. They have a right to vote, they have a right to net asset on a winding up, and they have a right to dividends on a distribution. So you now have to have 5% of all of them. But being reasonably lazy as they are, they cut this definition of ordinary share capital out of the Corporation Tax Act 2009, not 10, and it caused a big problem. Because a lot of people, when you are looking at family businesses, have what we refer to there as alphabet shares. So we're in a situation where Bob and I have got a company, and I'm the main operator of this company, and Bob is a stay-at-home husband. Let's do it that way now, girls. And what happens, therefore, is I want him to have a salary to tick the NIC box. So he gets a salary of 8.5, 10 grand, something like that. So he gets his NIC tick for state pension. But then when the dividends come out, I want to pay him a dividend which won't necessarily be the same as mine. And so what you're allowed to do is if I own A shares and he owns B shares, as long as they've got the same entitlement, then I can declare a dividend of 40,000 for me, and we can declare a dividend of, 14,000 for Bob, just using up his, his dividend allowance and his basic rate band, that sort of stuff, which takes it out of my 32.5% down into his 7.5%. And you can do that if you've got different shares. You sometimes do it where you've got, senior people bringing in juniors. They don't want to give them such a big share of everything, so they have this flexibility of being able to have different dividends voted on the shares. And as long as it's set up carefully, they do work. But the problem was, because Alphabet shares don't all have the same entitlement, there was then a discussion about whether, if there were Alphabet shares in place, you could have Entrepreneurs Relief at all. Now, that was a bit of a blow because there are an awful lot of Entrepreneurs Relief companies knocking around with Alphabet shares. Now, the revenue, when we spoke to them, because I'm involved in tax faculty, basically said, well, that wasn't what we were after. We were after a couple of very specific schemes which have been put in place. We're quite happy for Alphabet shares to have Entrepreneurs Relief as long as there is general interest in the business. So they put a second test in. So you've got your general first test, but you've now got this second test. If we sold the whole of the company, would you end up with at least 5% of the proceeds? So if I'm in the situation where I own B shares and I decide that I want to come out of the business and I'm going to sell them, what we have to look at is a theoretical sale of the whole business. Yeah. And then would I end up with more than 5% of that on the shares that I own? And as long as the answer to that is yes, then you can have your Entrepreneurs Relief, even though you might not technically meet all of the other conditions, the entitlement to dividend on a full distribution and the voting, not the voting rights, the net assets one. So you have got this situation now where Alphabet shares should now qualify for the relief. And it's quite interesting because when you look at it, if you're selling some of your shares, you're allowed to say, well, the company's worth £1 million. I've got 10% of the shares, therefore that's £100,000. And of course, we all know that the valuation of a 10% shareholding is not 10% of the value of the business because of the relative rights attached to the shares. But you are allowed to do it on that basis for this test. So we're in the situation now where your Alphabet shares should be okay, as long as you're going to get at least 5% of the theoretical proceeds if the whole business was sold at the time you are selling your shares. The other one is the 5% ownership. The only time you don't need 5% is if you received your shares under an enterprise management incentive scheme, because that's the one for the senior employees, and we quite often don't want to give them too many shares because they might then start to think they can do something with those shares, so we don't let them have that. So that's fine, you get the relief. But there have been situations where people who did own 5% of the shares are then disadvantaged because the company needs to raise money, so it makes a new issue of shares, and your holding now falls below 5%. Now, in that situation, what you are allowed to do is you are allowed to deem your shares are sold and then reacquired. So I own 8% of the shares, there is a new issue of shares, my holding drops to 4%, so I'm deemed to sell my shares and reacquire them, and a gain is triggered at that point, and that gain will qualify for Entrepreneurs Relief. Yeah? Now, what you can then do is you can say, well, okay, I'm going to deem this disposal, that's my first election. My second election, I won't pay the tax until I actually sell the shares. So what you're doing is you're taking your ownership period and chopping it into two. For this bit I owned 5%, and then for that bit I didn't. So when I sell my shares, the gain on the first bit qualifies for Entrepreneurs Relief and the gain on the second bit doesn't. And that helps in the situation where you have got minority shareholders and the company needs to raise some funds, and the way they're going to do that is by an issue of new shares. The only thing I would point out, which was on the previous slide, the share issue must be for cash. So it can't be shares issued on an incorporation where you've transferred assets in. It has literally got to be for a holding of cash. Yeah, okay, let's not bother with that. Now, employment status. It's about time this has happened. For years and years and years and years and years, people have been paid as self-employed when they have been, in reality, employees. People have been billing through companies where, in reality, they have been employees. The company is a bit of a sham. But of course, it's terrific news. When we first had this situation, say I left my company and then I came back and worked for them as a consultant. Yeah, this is what used to happen because you couldn't access your pension fund in the old days unless you'd retired. So the directors who got to 55 would retire so as they could access the pot in their pension fund, and then they'd come back and do exactly the same job, but they would be paid as a consultant. And of course, particularly in the construction industry, this is an issue. And so the revenue came up with this idea of IR35 and self-employed being classified. So if you are arguing that you're self-employed, but in reality you are an employee, they can treat you as an employee. And then it's the employer that gets caught for all the taxes there. So we started to set up companies to build them because you can't reclassify a company, and then realised that that was a really good idea because as self-employed we paid NIC at 2 and 9, we had income tax at 20, 40 and 45, but if we did our own company we could take an £8,500 salary and then the rest of it could come out at dividend. And of course in those days the first chunk of dividend wasn't taxed because there was a credit attached to us. So this was brilliant. Let's all set up companies to do it. And then the revenue started to look at it and say, well, actually, no, that's not fair. Just because you're billing through a company, if you are an employee without the company, then you have to take all of your money out of the company by way of salary. And that's what IR35 does. IR35, because it's Inland Revenue 35, that was the press release in the year that it was introduced. So what they do, I'm billing you as a company, I am a company which I own, I am providing my services in a personal capacity, and they say, well, if we take away the company, is there an employer-employee relationship between the person who is paying for this work, i.e. the client, and the person who is doing the work, who is the worker? Now, they only do it if it is providing personal services. If I'm the person who provides you photocopy and paper, that's totally irrelevant. That's not what they're after at all. And if there is an employer-employee relationship, and we look at the control, who controls what, when, how, and where do I do my work? Now, if I'm going to do something, people will say, turn up on this date at this time and we want you to talk on. There's no detail control over what I'm doing. Mutuality. If there is work to be done, do you have to offer it to me? And if you offer it to me, do I have to accept it? That's a classic employer-employee relationship. And then the third big one is right of substitution. If I couldn't turn up this morning, who would have provided the substitute? Would it be you, in which case it's more likely employment, or me, in which case it's more likely that I am not an employee? An employee wouldn't be expected to source a substitute if they couldn't turn up for work for the day. The firm would do that for you. There are others as well as financial risk and appearance of business, but the three big ones are control, mutuality, and right of substitution. And we started off with this, and then the revenue started to look at employment tribunals. And this Hermes Parcel Net one is to do with an employment tribunal because, of course, if you're not an employee, there's no sick pay, there's no holiday pay, there's no entitlement to, unfair dismissal rules or anything like that. And some individuals who were looking at this were saying, well, hang on a minute, I'm an employee, I'm not a self-employed contractor. And the employment tribunals are looking at it very much the same way as the taxman does and say, well, actually, yes, you're right, you are. And then as a result of that, the people who had been paying them as a self-employed contractor then had implications for pension contributions, unfair dismissal, unpaid holiday pay, and all sorts of stuff that is coming around. And there's been a big study on this, and what they've decided from a legal perspective, there are three types of individual. There's the person who works directly for the client, that's the self-employed contractor. There is the worker who provides their services through a separate company which they own, and then there's the employee who is the direct payroll, PAYE, and away we go. And so when we started to look at this, the revenue has sort of taken this as a plan, if you like, and said, well, okay, what we're going to do is we're going to work along the same sort of lines. And they've had a real blitz recently, particularly on television presenters. And the reason they do this, of course, is because of the publicity it gets. And people who are not in the public eye look at this and think, ooh, actually, yeah, I think that probably might apply to me. Because apparently only 10% of the companies in the UK which should be IR35 actually declare themselves to be IR35. Where they get that number from when they don't know how many are not declaring, I don't quite know, but that the revenue says it's 10%. Now, Lorraine Kelly, I love this one. She does the morning show on ITV. I don't watch telly in the morning. And she basically said, no, she wasn't an employee of ITV because what she was providing was her services as a star. It wasn't Lorraine Kelly doing this, it was the persona who is Lorraine Kelly. And there were a lot of arguments around that. And the company she was billing them through was held not to be an IR35 company. Kay Adams, you might hear her, she's BBC Radio. And in her case, when they looked at it, they decided that in the situation that she was in, then there was a bit of a relationship because she didn't work for anybody else. Lorraine Kelly does. She's got other shows, she does magazine articles, she does all sorts of promotional stuff. Kay Adams just worked for the BBC. She worked sort of set hours, it was something like 200 and odd days she worked for them. And although she ran the programme, they had ultimate control over who she brought onto the programme and effectively what she was allowed to ask. So when they came to it, Kay Adams basically had a contract for services, and then the other one that they brought in was Krista Ackroyd, and it is Krista, it's not a spelling mistake, but she was held to be an employee. And there were lots of differences between the two. So Kay Adams got half her income from the BBC, but Krista Ackroyd got 90%, so basically practically everything. She couldn't do any other work unless the BBC said she could. Kay Adams had a lot of ability to go off and do all sorts of things. So again, Kay Adams was outside IR35, but Krista Ackroyd was inside IR35. And IR35 basically is the personal service company that is required to only take the money out by way of salary. So you can't pay yourself, well, you can pay yourself a dividend, but it's not taxed as a dividend. Everything comes out by way of salary, which triggers the employer's 13.8, which triggers your 12 and 2%. It is all treated as salary. So they've had quite a lot of these cases knocking around recently. And what they decided to do is to take the case one step further. And 2 years ago, they introduced these rules for public sector. Now, I suspect some of you here will know all about this, working for a public sector body. But what they basically said was, if you are a public sector body, and that is a body which is subject to the Freedom of Information Act, that's how it's defined, and you pay somebody's company for their personal services, in such a way that if we ignored the company, they would be treated as an employee, then the public sector body has to put the payment through the payroll. So if I went to work for the BBC and they paid me a fee of £40,000, say, that would have to go through the payroll. And they have to put me on the payroll, and we go through the starter procedures, and there's tax, and there's NI, and there's all sorts of stuff that goes through. The VAT is not included in that, so they put the 40,000 through the payroll, work out what your net pay is, then pay you plus the VAT. And of course, for me, that's an absolute disaster, because if I am an IR35 company, I can take 5% off my fees before I work out my tax, and I can claim travelling expenses. Whereas if I am being treated as a worker of the BBC or whoever it was I said I was going to work for, I can't claim travelling expenses because that contract is deemed to be a permanent employment. And therefore there's no travelling expenses because I'm not going to a temporary workplace anymore, I'm going to a permanent workplace. So I lose my deduction for my travelling expenses and I lose my 5% deduction. And the employers aren't terribly happy about it either, because they now, instead of paying 40,000 plus VAT, have got to account for 13.8%. And of course, for a lot of people, there's the apprenticeship levy as well. So it becomes very, very expensive. And it was a total disaster because, of course, a lot of, if you look at NHS trusts, an awful lot of the doctors and the consultants and even the nurses were billing through their own personal service company. Now, in some situations, that's what they've been told to do by their advisors. In some, they were just told that's what you're doing and there was no choice. And I feel sorry for the ones who were just told that's what you're doing because now they're in a bit of a difficult situation. But when you look at the HMRC, they are way behind on an awful lot of their IT projects. I mean, MTD has been a disaster from an IT perspective. And one of the reasons behind that, of course, is that when they introduced these new rules, 64% of their IT team walked off the job, because they were all hired in through personal service companies. And because they had the expertise and they can go and get work somewhere else, they said, you know, sod this, I'm off. You know, what is the point of doing this and ending up with less money than if you did it somewhere else? And so it has been a bit of a disaster, but notwithstanding that, the Revenue are going to introduce this from 2020 for all activity, not just public sector, private sector are coming into it as well. Now, at the moment, this is what we think is the exemption. It's not finalised yet because the legislation hasn't been passed. But if you are a small business, then you are exempt from these rules. So you won't have to worry about looking at who you're paying. A small business, they're using the Companies Act criteria, not the normal tax criteria. They're using the Companies Act criteria. If you're not a company, they're only looking at turnover. And if you look at that turnover, you've got to be a bit of a substantial partnership or LLP, really, haven't you, before you're going to get up to that sort of limit. Now, the Revenue is saying 95% of businesses will not be affected by this, but the general consensus is that is an estimate is much too high. So from next year, From next year, you're going to have to look at this and decide what are you going to do. So I am the person who's doing the work. I've got my own company, MH Training Limited, and I am now going to bill somebody for work that I am doing. So I'm going to bill Kaplan, which is who I used to work for full time. They will meet the criteria of not being a small business, and therefore they've got to look at the payment to me and decide whether it falls within these rules or not. If you go over the threshold partway through the year, you don't come into the rules until next year. And as I say, if I do fall within this category of deemed employee, you have to put the payment to me through the payroll. I become a worker in the legal sense, in that they're going to put me through the payroll, but I don't get any of the other employee rights, sick pay, holiday pay, unfair dismissal, etc., etc. And I'm going to be not very happy because if I was an IR35 company, I'm losing my 5% deduction and I'm losing my travelling expenses. So are you going to look at it and say, okay, do I not use these people anymore? So is that going to impact on me because I won't be able to get the sort of work that I was able to get before because people are not prepared to pay you through a company in this way? And what are you going to do about the whole issue of looking at it? The public sector rules, when they came in, a lot of the NHS trusts said, I haven't got the money to do this, I haven't got the expertise or the resource, we are just going to put everybody through the payroll. even where there was absolutely no justification for it whatsoever. And what the revenue have said this time is, if you say, I am going to put everybody through the payroll, then we are going to say that you are making a careless approach to this, and therefore there will be penalties. So you have got to look at everybody on an individual basis. And then, if you then send this letter, you have to send this what's called status determination statement. You send this to the individual who's doing the work, and if they disagree, they've got 45 days to come back and say, no, I think you're wrong. And then the person who sent out that letter's got to justify the result. And an awful lot of businesses will just send it out to everybody and just hope nobody says anything, you know. It becomes more complicated where you've got labour chains, so you've got the client who's paying an agency and the agency is paying the worker. I think that probably is a little bit over the top for what we want to do this morning. But when you are looking at this status determination statement is really important. And if you don't send the status determination statement out, it's the client who then becomes liable for the tax and NI, not the individual doing the work. So you've got to provide this statement to tell them how you are going to treat them. Now, if I'm looking at this, am I going to start looking around and go, well, I'm not going to work for you because you're a large business. I'm going to work for you because you're a small business, and therefore these rules do not apply. If I've got existing relationship with businesses, am I going to turn around and say, I want a higher fee? Because I'm not getting the 5% deduction and I'm not getting the travelling expenses. But are you going to turn around and say, but we've got to pay the 13.8, so we want to pay you a lower fee? And you cannot legally recover the 13.8 from the employee unless it is in the contract. I know some local authorities, particularly when it first came in, decided just to take the 13.8 off what they paid, and they can't. It's got to be in the agreement. But if I'm desperate for the work and they say you've got to meet it, I might not have any choice. So this is coming in April 2020. So people have got to look quite carefully at all sorts of things like their payroll procedures, the link between the accounts and the payroll, because you're going to be putting stuff through the payroll and then it's going to go into the accounts. And when you do your VAT return, it's not going to do a reasonableness check because you're paying it net of tax, and the VAT's going to go, but if I add 20% to that, it isn't the VAT that's been charged. There's going to be total mayhem on this one. And you've got to look at these sort of people on the basis of your take-on procedures. So there is a huge amount that people have got to look at. And the revenue have said, well, it's all right, if you're going to have to do this, you can use the checking the employment status tool. And this at the moment is absolutely not the thing you would recommend your clients to do. This is, you type in the answers to some set questions. I do it every now and then. If I'm bored, I go in and I just type in some hypothetical situations, see what answer it comes back with. 15% of the input comes back with, I can't answer this. Yeah, so that's not very good. And it totally ignores mutuality. And the revenue's view of that is, well, if you're checking, you must already have a relationship. And therefore, we don't need to look for mutuality because you must already have it. But that's rubbish. They could be checking to see whether I would get caught before they offer me the work. So there is no guarantee that there is mutuality there, and so that really has got to be changed. Now, they have said that they will update it for April next year, but as I mentioned before, they do have a slight IT issue at the moment, so the chances are it might well not be done. This is one of the reasons, I don't know if any of you follow VAT, there was a big change coming in on the 1st of October this year on labour chains and VAT, and they've deferred that to October 2020, they announced this week, because they just can't get their act together in time to get the new systems in place, to get the new reverse domestic charge in place. And this is an ongoing problem with the revenue. They don't have the resource. It's not their fault. They haven't got the money to do it, or they haven't got the money to do it properly. I will defend them on that one. So you have got to be quite careful about this one. So this is a huge change. But I will make a statement at this point. I bill my work through a personal service company. A personal service company is a company where the individual who owns the company provides their services on a personal basis. But by no stretch of the imagination am I IR35. I don't do enough work for any one business that would bring me into the employer-employee relationship. I go, I do a job, I go and I do another job, and then I go and do another job for somebody else. So there is no way I'm IR35. So if these rules come in, I should not get caught up on this. But I bet you I will get status determination statements from at least one group that I work for saying they're going to treat me as an employee. At which point they will get a very considered response telling them to bugger off because it doesn't work on that basis. Okay?
Just when you said there was no right of appeal by the...
There wasn't for the public sector.
Right, but there is...
If I get this status determination statement, I've got 45 days to go back to the person who sent it and tell them why I don't think it applies, and then they've got to make a decision and come back to me and say, oh, okay, or no, we still think it applies because. And then if that happens, you get to the end of the year and you try and fight it out with the revenue when you're doing your self-assessment at the end of the year, which is going to be difficult.
And what's the benefit for national insurance?
Well, you're going to have to, if they won't back down, they're going to take national insurance off, and then it'll be up to you to argue with the revenue that they shouldn't and it needs repaying.
Which will be separate from your self-assessment, so you...
Yeah. But you can actually just speak to them separately about it. And that's what I would do, or that's what I'd threaten to do anyway, because of course, as soon as you say this company is deducting tax and NI, and I don't think they should be, and here's the reasons why, they're going to be going to this and going, oh, let's see if they're making blanket decisions because we can go after penalties. And the larger companies, they will fine the senior accounting officer because they are responsible for ensuring that the processes operate as they should do. And the number of fines for senior accounting officers has doubled over the last couple of years, and the vast majority of those have been on employment status. So the guy at the top of the chain could end up with a £5,000 fine, plus a £5,000 fine for the company because they're not operating the system properly, plus penalties and interest. And potentially, if they really go for them, they could just make them responsible for all the tax, which would be great, obviously, because then I wouldn't have to pay any. But no, there is an acknowledgement by the revenue that there will be situations where you have tax deducted and you shouldn't have done, and then it's up to you to try and fight your corner and get it back. I know the particular one I'm talking about will just back down because I've already phrased the letter in my head, I've already written it, I know what I'm going to say. Do you realise who I am? Not quite, but along those lines, because they'll just take a decision, because loads of people who work for them will be caught up by these rules. It's because they've left the business, but they've just gone back and they're freelancing for them, and that's all they do. But it doesn't apply to me. I do too much other work as well. Hopefully. Okay, right. Structures and buildings allowance. This is the new capital allowance that came in last October 2018. But the thing about this one is the whole project cannot have started before that date. So if you've bought the land before the date, no relief. If you've got your planning permission before the date, no relief. The whole thing has got to have started from the 29th of October. Planning, when you're just thinking about what you're going to do, fine, that's not a problem. But if you've actually incurred any expenditure on planning permission, legal fees, anything like that, you can't have the relief. So it's only for projects on or after the 29th of October 2018. Now, it's a 2% writing down allowance straight line basis, so 50 years, 2% of whatever it is. If for some reason you don't claim it, you can't carry it forward. At the moment with capital allowances where you've got your pools, you've got your entitlement to 18% or whatever, and if you choose not to claim that, the balance carried forward is that much bigger, so you will get it in later years. But here, if you don't claim it, and you might say, well, why don't you claim it? It's usually individuals whose income is so low, they're going to waste their personal allowance. So they don't claim capital allowances in that year because then their trading profit is higher, and then they'll get higher allowances in later years. So that's what it's for there. It's new and renovation of existing properties, and they can be overseas, the properties, which is quite unusual for allowances, providing the property is being used to generate profits which are taxed in the UK. So what I'm looking at is a UK company with a branch in Malta or a UK company with a permanent establishment is, of course, the proper term, but we're operating overseas, but the profits are taxable in the UK, then you can have your relief. It's primarily commercial property that we are looking at. It is quite definitely not residential property. And you can look at all sorts of stuff. If you've got a mix, say I've bought a property and there's a shop underneath it and a flat above it, then what you're looking at is having to apportion it. And what they said in the technical note is if the residential element is less than 10%, you can ignore it. If it's more than 10%, then you've got to do a little bit more work on it. And you can't have it for all the sort of residential property. So although a lot of the halls of residence you run as a business, so they are commercial to that extent, because they are used for residential purposes, they are not going to qualify for the relief. Okay, and I love the fact that they put prisons in there, because it sort of implies that you're quite happy to go in it. It doesn't apply to furnished holiday letting, because although that is a business, again, it is residential property. You can claim it on the cost of the work. You can't claim it on the work on the land itself, or any of the legal fees that go through it. And I've been a bit lazy there. I should really say SDLT, LTT and LTB now, because of course we've got the Scottish and the Welsh equivalents of stamp duty, land tax. You don't get them for any of those. They will of course become part of your cost for CGT when you sell it later on. So the things that you wouldn't normally get relief on through the revenue deduction are not going to get the 2% allowance. And this is going to mean that you are going to have to look very carefully at the analysis of your property. Because when you buy a building, you're going to have the land, which isn't going to get any relief. You're going to have the building itself, what I would refer to as the bricks and mortar, where you should be able to get the 2%. There might be an element where you're not going to get anything because, maybe it's a big industrial complex, but you have residential accommodation for security, you sleep there overnight or whatever, and that's not going to qualify. You have to split that out. We've got assets that qualify for the first year allowance. That's your environmentally friendly and your water efficient and your sewage efficient stuff, where currently you get the 100% ECAs, but I'm going to mention that again in a second. You've got your integral features, which is your electrics and your water and your heating and your movable walkways and all that sort of performance. That goes into your special rate pool. Of course, it's important that they're split out because they've just dropped the writing down allowance to 6% on the special rate pool. And then you've got your plant and machinery, which is built in, which qualifies for capital allowances. And then you've got other things which you're not going to get a relief on at all. It's going to be very complicated, and if you're doing a big commercial project, it's going to be quite important you have somebody in there who knows what they're doing. If you're looking at it from a more theoretical perspective, you have to start with section 21, 22 and 23 of the Capital Allowances Act, because that's where you get the definitions of this is building, but it qualifies as plant sort of thing. You get that sort of stuff. But that's been overwritten, because if you look at that, your power and water systems, cold water systems, wouldn't get any relief. But if you move on to section 33A, which is where your integral features are, they are included as integral features, so they will get relief. So it's not quite as straightforward as it seems, and there's going to be a huge amount of work got to be done on this to make sure that you get the right figures going into your computations. If you buy a property and then you extend it, the extension will have its own 50-year life. So it's not like the old rules where if you had a property and it was partway through its life and you spent money on it, it's all ended at the same time. No, this will have its own life. And if you demolish it, you can carry on claiming for the 50 years. They call that shadow structures and buildings allowance. When you sell it, and this is different for everything else, there are no balancing adjustments, no balancing allowance, no balancing charge. You just have the 2% passes on to the new owner for the remaining of the 50-year period. And if they sell it before it gets to the end of 50 years, then it passes on to the next period. Now, because of that, what's going to be really important is that we are going to have to make sure that the person we are buying from
is able to produce a list, because if you look at this, I need to know a lot of that information, because if I buy a building which has got fixtures and fittings in it, they've got to provide me with the information, and then if we're happy with it, we make the 198 election, and their figure for their disposal becomes my figure for the acquisition. If we're not happy with it, you have to go to tribunal, and then you use the figures that come out of the tribunal. And that's your pooling election and your fixed value election. Well, this is going to be similar. If they're just going to get 2% on the qualifying cost, we are going to have to provide that information to the purchaser. And that is even if the business is not taxable. So where you've got some of these large commercial properties where the entity that owns them doesn't pay tax, they are still going to have to keep this analysis because they need to pass it on to the next owner, and there's a default if you don't. Now, when you come to look at the capital gains tax, you then have the situation where the capital gains tax used to reflect, if I sold it at a loss, it didn't matter because the capital allowances had sorted out. Well, of course, it doesn't anymore because we don't get any balancing adjustments. Now, this is a revenue example. So you buy a property for 16 million, of which 6 million is the land. Now, they've assumed that the other 10 million is then all the structure. So there's no plant and machinery, there's no integral features, that must be somewhere else. So the whole of the 10 million is your structure. So we get 2% of that writing down allowance, which is £200,000. We sell it 10 years later, by which time we've therefore claimed £2 million in allowances. We sell it for 14.5. Now, the fact that 8 relates to the land doesn't matter. The capital gains tax is on the whole amount. The relief doesn't go on the land, but the CGT is on everything. So you work out your gain, it's 14.5, and you might think you've made a loss because it cost you 16 million, but it doesn't work like that because you've had £2 million worth of capital allowances. So your base cost becomes 14 million for CGT purposes, and then your gain is 500,000. And whoever buys it from you carries on with £200,000 per annum for the next 40 years. Okay. As I say, if you are a non-taxable entity, you've still got to provide all of this information. If the use of the property changes during the year, there's an apportionment which you will have to do on a time basis. And there are some quite complicated rules with regard to leases. And it depends on the life of the lease and how much the premium is in relation to the value of the property, whether the lessor or the lessee get the relief. So it's a bit along the lines of long funding leases. It's the same sort of idea. And then the final one you'll be pleased to hear, I was talking about the energy efficient stuff. Energy, water, sewage efficient technology gets 100% relief in the year that you buy it, assuming it is new. You don't get it on second-hand property, you only get it on new property. But what they're doing is they're stopping that in April 2020. Now, logically, you'd say, well, why are they stopping it? Well, there's two reasons why they're stopping it. Firstly, because businesses are very much more commercially aware now of the benefit of buying things which are energy and efficient technology, etc., etc. There is also a sort of, I don't use like the term PR, there's a sort of imperative these days to be seen to be aware of the environment, etc., etc. So again, that pushes you towards those sort of areas. But also, the annual investment allowance whipped up to £1 million on the 1st of January for 2 years. So a lot of businesses, if they don't get the 100% for this, well, it doesn't matter because I'm not spending anything near £1 million on general plant and machinery, so I can claim annual investment allowance instead, which of course then relieves 100%. Now, the problem with that is that if you make a loss as a result of a first-year allowance, you can sell it back for cash. And you get back, I think it's 2/3 of the current corporation tax is the rate of repayment. But if you make your loss as a result of your annual investment allowance, there is no repayment option. So for some businesses, it's not going to affect a lot. There will be a little bit of a cash flow problem with this. They are leaving the electric charging points. That's going to stay in for another 4 years because, of course, that's the big push, isn't it? We are all going to be driving electric cars within the next 15 to 20 years. And to do that, they need more charging points, so they're keeping the 100% relief for that. And that is to particularly encourage the employers to install them in the employees' homes. And that means they'll get 100% relief for it in their corporation tax computation, and the employees will be more inclined then to accept an electric car as their company car, if we can use that terminology. So quite big changes there.